Hi everyone, my name is Vesrusif and this is episode 32 of the East Auckland Properties Show. Today we're with Brandon Lipman from RFI. We're going to discuss a recent change that has happened on the market with regards to finance and see what his perspective is. Hi Brandon, how are you?
Good. How you doing?
I'm good, thank you.
Good to see you again.
So there was a recent change in the OCR from the Reserve Bank at the beginning of August. That was a little bit, can I say, unexpected?
Yeah.
Yeah. And can you please just explain a little bit more about the change and how has this affected the market, if it has?
Yeah, for sure. So the sentiment over the last few years from the OCR or from the Reserve Bank is that the OCR, the official cash rate, is going to continue to decrease. And I guess that the headliner of the OCR and the biggest punch that it has for borrowers is that that's the rate that the mortgage, that's how the level that the banks can borrow from the bank, for example, from the Reserve Bank.
Yeah.
So you have the scenario where you've got the Reserve Bank, which kind of is this big kind of a governing body that sets all the rules and speed limits and regulations for the trading banks. So you don't necessarily, as a consumer, you don't have your money with the Reserve Bank, but it sort of sits at this other level and they're governed by it. So the OCR rate affects that, and because it's dropped, it means that the bank's money is a little bit cheaper. And if the bank's money's cheaper, then surely the consumer, so you, me, anyone around here, their mortgages should be a little bit cheaper as well. So the OCR, it normally drops, and it drops in basis points, so 25, so 1/4%, and so then the decision was made for it to drop twice the amount that it normally would this time.
Okay.
And
do you know why was that decision made?
Look, I think that decision was made by the Reserve. I don't know exactly why they decided to make it. I guess that they'd seen a lot more stability. I think a few of the points that people have been talking about is that specifically around employment being at its maximum sustainability at the moment. We're entering into like a very kind of going a little bit further from the housing market, but we're entering into a different kind of era in New Zealand. I think it's a sentiment a lot of economists are feeling. So this isn't my view, but what everyone else is saying is they're saying, well, New Zealand is of some of the few countries that are relatively underdeveloped for a developed country. So people have termed it, we're about to have our Singapore moment, which is where New Zealand's about to actually go through a bit of a construction boom, change the landscape, that sort of stuff. So I think we may be on the cusp of that, but this is what other economists are saying. I'm just interpreting what they're. So yeah, I think perhaps there is where the pressure really exists in a situation like this is when the Reserve Bank drops the OCR, and then all of a sudden there's backlash from the community saying, why are our mortgage rates so much higher? You borrow at X, you lend at X, you make 10 times the amount that you're borrowing at Y. And then that's margin. A big, so it's a big, and it can be a big margin. Again, mortgage rates have dropped so much, especially as of late. And I remember the first mortgage that I took was about 5%. So and that wasn't really large per se. And now their rates, I think some of the advertised rates are 3.69. Some are maybe a little bit. I think QE Bank is doing a very low rate advertised for staff and employees. That's underneath. It's put.
So was that effective immediately?
So what will normally happen is there's something like that will happen, and then the banks will take a moment to react to it. So the OCR cut will happen on I think it's been happening on a Wednesday. I think it had happened on Thursday before, but so Wednesday, Thursday it'll happen, and the banks will kind of convene and then sort of wait there, doing the old pistols out. Who's gonna make the move first, right? So in this scenario, one bank will normally put their head up and say, all right, we'll move it, and then everyone else has been very competitive and staying to match. So we haven't seen any kind of ridiculous pricing or anything crazy come out, as in anyone really go and take charge and lead the market. There's one offer out there that's for staff and employees that's out in the market. Do we want to do something about
I don't know. It started raining.
Okay.
Probably we have few more minutes.
Yeah, well, it's because it's really key information. This is why I have again. Yeah. So, so the I guess the situation moving forward. Oh, we might have to.
Yeah. Okay.
Should we go this way?
We're gonna come back. How do you think this will affect the overall financial market and the lending, and how this will relate with property and the property market?
Cool. If I'm gonna make a prediction on what will happen for like mortgage borrowers in the future, I reckon borrowers are going to be able to borrow more soon.
Okay.
So I reckon people are going to be able to start borrowing more money to buy houses that may have been just out of reach previously, or houses that or they might have just saved, or say for instance they'll lift more of the rules around say low LVR or low deposit loans. Yeah. So if you're a borrower at the moment, the way, and we've spoken about this before, they test your mortgage, they stress test it, so they put a higher interest rate. Yeah. We've had pressure put from our side as mortgage advisors onto the bank side, because the testing rates, they're so different. If there's a mortgage of say 3.7%, if you double that, that's 7.4% in total. But there are some banks who are testing mortgages at more than double that. So if they're testing more than 7.4%, it's more than double the actual rate that they're paying. So if you're taking, and they test it over, in some instances, a 30-year principal and interest loan. So because they test it over 30 years at double the interest rate, you end up needing to pay your mortgage. You need to be able to afford it at like a 16, 17-year term to be able to take it over the 30. Yes. Which is understandable. Rates can go upwards. They have to lend responsibly. Yeah. But now that the rates have come down, the question really is, okay, so that has to fall down with it. So actually today, one of the banks has dropped theirs significantly. So it's not to say that you're going to be able to borrow a heck of a lot more, but one of the major banks dropped it by 0.5%, the test rate, which does make a bit of a difference too. So I think that we're going to start to see more of the banks playing around that, and that's really for some borrowers who kind of on the cusp of being able to afford a house. The decisions that they make when they come to a mortgage advisor is, well, when they're looking to buy something, they might ask for the maximum that they're pre-approved for. So there's a pool of people who want to borrow as much as they can by the bank's rules. That's normally been a part where the banks will be competing for business based on, you know, how much they are willing to lend people. So there are a pool of people who need to borrow more, and they'll go to a particular bank for that reason. And if you start to fall out of market, then you start to see less people coming to you as a bank, and you start not being able to put together the loans for people, you lose business. So the rates will have started to drop because of an OCR cut, and then that puts pressure on the banks to say, well, the rates are so cheap, people can probably borrow a bit more now because the rates are low, and people can actually afford to borrow more.
It's interesting. So if I have to read, you know, from my perspective between the lines, it means there's going to be a little bit more activity on the market, a little bit more people looking to buy or be able to afford expensive properties.
So I think that people are in a position, or that some of the activity that I'm seeing, there are people who are able to, people who are looking to upgrade their property, so they're selling their current one and their family has grown, or they're moving school zones, or something's happened, the family's gotten bigger, so then they'll sell their home and then they'll move into a bigger home, they'll take a slightly larger loan. So there's that piece that's happening. And I think that because it's the affordability side of things that's changing, that's not in the face of the public, so the public don't actually know that that's really the underlying, or it's what's changed for, their position. So I think people will be more surprised at how much they can borrow. So when someone comes and they're looking for a pre-approval, they'll be able to afford a bit more. So, you know, it's not to say that prices are going to increase at property, but the ability to buy a property is certainly the difficulty to purchase a property is being reduced.
Do you think the banks will go aggressively on advertising all that changes in the lower interest rates? Because this is how the public will find out.
There's been a big change in the. I read the CoreLogic report for last quarter. So 25% of the market share were first-home buyers. Which matches
on average,
around that, and that matches, I think, historical. Like that's really where they sort of tap out in the market.
In some of the regions, goes up to 50%.
Oh, it does. Okay. So you get these first-home buyers who are now out there in the market, and when the first-home buyers sort of step up, the investors that can be traded properties, could be for what reason. But the first home buyer, when it sort of gathers speed up to that point, you start to see this transition into first home buyer workshops and seminars and that sort of stuff. So then it's, hey, how to buy a house actually becomes relatively important, and then in a few years it then becomes, how to buy an investment property. So at the moment we're kind of what it's doing is it's recalibrating the market, and everyone's thinking, well, how do we actually buy a house? And then that piece sort of gets figured out for the next few years.
And just another aspect of the change, will we see a lot of people trying to refinance their existing mortgages?
Yeah, good question. I mean, the rates have dropped further, and it's a few years ago people were refinancing for better interest rates and better deals, and now that's come back up again. So the banks offer cash incentives for people to switch banks, and that's what stimulates that kind of behaviour. And because the mortgages are 1, 2, 3, 4 year, 5 year terms, when the loan comes up for review, and then when it is when the person's faced with the decision, do I end up remaining with the bank, or do I go anywhere else, they're on the market again. So the banks, by one, the loan structures that they have, and then two, the cash incentives that they offer for new business, they're influencing each other in the market to look at their options because they're paying for business. So yeah, people will refinance, and if there's people sometimes who have a owner-occupied property, a investment property, or a couple investment properties, there's a whole restructure that goes on too.
Consolidation.
And things will happen, like interest-only terms will come up for review. They have to reapply for them. If they have to reapply, they can go to market and see who's doing, and that's what these people are doing.
So probably you'll see also in your business more pick up in the refinancing part of the...
Yeah, the refinancing part is people come to us to roll their mortgages over, and then when that happens, they'll sometimes ask, well, I've come to a broker and you work with other providers, what would another offer look like?
Okay.
So we have to approach the client's bank first. We have a relationship agreement with all the banks, so we do our best to, one, make sure that their offer that they have there is actually market competitive. Because if it is, then they shouldn't be looking anywhere
or if
else.
they can match the conditions of other banks.
Exactly, and quite often the market's very similar at the moment, so there has to be a very strong underlying reason to why you would want to leave the bank, and then that's when things like the interest-only periods come to contention. So yeah, the lower rates draws attention to that, but it can be a fallacy for people to kind of think, oh, I should be switching, or I should do this. There's another conversation that needs to be had, and but it's great seeing that the rates are still decreasing. It means it's cheaper for people to borrow, good opportunity for people to pay down debt as well, because now their debt that they borrowed previously is even cheaper. So yeah, it's kind of eroding the cost of the mortgage, which is brilliant.
What's the downside of having a lower OCR?
Okay, the downside, I'm going to keep it just strict on the mortgages, for example. If the low OCR happens, you end up with lower interest rates, and what it does is, because the low interest rates are there, people borrow because the interest rates are low.
Okay.
Yeah, so then people will accept a lower yield because interest rates are low. People will upgrade their house, or they will top up to do other things because the interest rates are low. So it's a quick, it's cheaper, I'll do it kind of approach. So if you're making a decision,
risk of overspending,
overborrowing, overborrowing, overspending. So admittedly, if the test rates for lending applications are double the interest rate, it's not to say that you're going to over borrow. You probably still could. But if you're going to borrow to do things, if your decision to borrow money is made because the rates are now cheap, you have to, still make the do you want to put a pool in your house? It's going to cost you $100,000, for example. If your decision is to put the pool in, only because the rates are now cheap, you're spending $100,000 still, plus the interest. Another risk is you have people who will upgrade the homes further than what they may want, and because the interest rates are low, the upgrading a home is pretty dangerous, because if you've been in your house for 10 years and then you have a 20-year mortgage left, and you upgrade your home, you borrow and you upgrade to the maximum that you possibly can, and then you start that mortgage on a 30-year term again, you've actually had a 40-year mortgage on a mortgage that's bigger than what you originally started. So those are the kinds of things that people can you can trick yourself into thinking, oh, I should borrow a little bit, I should do a little bit more.
Thanks, Brandon. Thanks for the time, and guys, thanks for watching. See you next time. Bye-bye.